Hello, this is Eric Boyce, CEO and Chief Investment Officer for Boyce & Associates Wealth Consulting, and welcome to Charts and Chat for April 7th of 2024. Well, I suppose the best place to start in the chart pack this week is to talk about the eclipse. It's kind of a big deal down here in Texas, Central Texas, although we're not quite sure if we're going to have the weather to be able to see the sun go behind the moon. But it will get dark. We do know that. We're in the path of totality. And so I offer you this chart, which is very interesting, in several publications I was looking at. So this is basically a list or a chart of the basically Airbnbs and the percent of which that have been leased out. And you can see in the occupancy graphic, the legend up there in the upper right hand corner, you get more orange the closer you get to 100%. And guess what? In that path of totality, most of those listings have been booked up. Now, this is not a surprise, but I thought it was intriguing and, again, something that we're not likely to see again for another, I believe, 300 to 400 years. So anyway, so this is kind of a big deal for people that pay attention to such things. And I do understand that you want to be as close to the path of totality as possible. And right now, the weather forecasts are not terribly encouraging for us to be able to see it, but nevertheless, good for the economy when you have a lot of mobility and you have a lot of properties that are for rent here in our area that are basically leased up. So that's good from an economic standpoint. Now we'll go ahead and jump into some economic data news from last week. We got non-farm payrolls. You can see here that March was slightly up. You can see a 3-month positive trend heading into the first 3 months of the year. So very curious to see where this goes in the second half. It's kind of a tale of multiple cities here, as we'll see in a second. But we do have payroll strength that continues to kind of defy logic here with these very tight interest rates. And just remember that here on a short-term basis, we've got interest rates that are higher than the rate of inflation. And we've been talking a lot about how inflation's apt to be a little bit stickier. But this is an environment where you usually see a little bit of erosion in the labor market, but it's been exceptionally strong here as of late. You can see here 300,000 in the most recent reading. And here we have the unemployment rate. It's 3.8% for the month of March. You can see after the post-pandemic environment where we saw that unemployment rate begin to decline, the economy got out of its shadow. We can see it holding really, really closely to these 50-plus year lows. And it's very unusual to see this at a time where you've got high interest rates and tight credit conditions, but that is absolutely the case. Now, we'll tell you that large companies tend to feel a little bit better about things than small companies do. A lot of that has to do with access to credit and expansion capital, so on and so forth. Smaller companies and smaller enterprises, don't have those luxuries to a large extent, and so. Now, here we are at a point where the labor market is just unusually strong. So continuing the labor discussion, we've got two charts here. On the left-hand side, you have a plot. In the black line there, you have initial jobless claims, which we've just been talking about, being stubbornly soft, I guess, in terms of the unemployment numbers. And then in the purple line there, you've got continuing claims, which has been eking up a little bit, as we've seen here. We've got that, that's on the left-hand scale, so that comes out to about 1.7 million on continuing claims. And you can see the initial jobless claim numbers, about 200,000. So both of these numbers are important in their own right. It kind of reflects an environment where the labor market seems to be relatively strong. Continuing claims, the more that you have initial claims that are sticky and people aren't able to find jobs, that continuing claims number continues to eke up a little bit, but it's not troubling, essentially. It's not nearly as high as it was, and it's kind of in that band that you would expect if you had an economy that was kind of operating pretty well and on all cylinders, basically. And that's what that chart looks like. Right-hand side, we do have the challenger job cut announcements. It picked back up in the latest couple of readings. You can see it's been oscillating, just under 100,000, and these are kind of larger companies, if you will. So, and you get into larger companies, you tend to have more publicly traded firms, and in that light, some of these announcements are tied towards companies trying to manage their earnings. Obviously, with most companies, I'd say by and large, you've got labor that is at least half of the cost structure, if not slightly more. Service businesses are more than that. And so, labor is an easy way to help manage earnings in that regard. And, I think that's got something to do with it. Obviously, if you look at the left-hand side, you see, oh, well, the labor market's pretty strong. Look at the right-hand side, say, well, all right, maybe people are being a little bit cautious here at the large company side. Here we have job openings. So, as we kind of reflect on the last couple of charts there, I mean, we've got construction and we have retail. And as I said, this is a tale of two cities. There are other charts in here in this particular series of charts that I didn't publish. We've got food service, you've got healthcare, you've got government, you've got different sleeves of the economy. But I thought this really kind of captures the essence of what's going on. So construction, we know, still pretty strong. There's a backlog of projects. A lot of developers are having a little bit more trouble getting access to capital, and certainly it's coming at a greater expense to them. And then retail, we know, by and large, retail's been pretty strong, but the hiring boom is definitely over, and you can see, where we are in terms of job openings relative to the pre-pandemic environment. And we're certainly below that. And so I think some people are being a little bit cautious. I think some retailers are taking it a little bit tougher right now. And I think we're going to learn a lot more about retail over the coming weeks as we get some of these first quarter earnings reports. But clearly a tale of two cities here. Now we talk about the ISM manufacturing PMI. It's several acronyms there for you. As we've said in the past, ISM is the Institute for Supply Management. PMI is the Purchasing Managers Index. So this is basically the manufacturer's index, and you can see it perked above 50 here in the latest reading. And so, we did have 16 straight months below 50, and that was a bit concerning because that tends to correlate with recessions. And we did not have one, at least as far as we know, and we certainly didn't have a negative decline in GDP last year as we thought we were, but you can see with PMI picking up and heading into expansion territory. So anything above 50 here represents expansion. And so that's a pretty good sign of where we are in the economy. We'll talk a little bit about couple things that kind of caught my interest here. We got Brent crude oil futures. That's hitting 90. We've got West Texas Intermediate that is moving in the same direction, heading to kind of it's still in kind of that shoulder season. We're transitioning to some of the summer blends, which will be the peak driving season as we head into the latter part of next month. And so this is something we want to pay attention to. I mean, it does affect consumer sentiments we talked about. It's one of those, clear-cut areas aside from your grocery bill that you can tangibly see the effects of inflation when it comes to you. And so you got oil futures, and it gets broken down into distillates. So this translates into potentially higher gasoline. And this is reflective a bit of geopolitical tensions over the last week. Obviously, we had a lot of rhetoric with regard to the Gaza incursion and Israeli attack on Iranian interests in Syria, and what are the reprisals of that going to be? What's the future of Prime Minister Netanyahu? A lot of unknowns, and that helps to drive crude oil prices up. Interesting chart here. We've got college enrollment growth, as we've been talking a lot here lately about our own college planning practice that we have acquired, and just talking about the cost of education overall, and it's really getting out of hand in some cases, particularly on the private institutions. And a lot of students, frankly, not able to avail themselves to those. And you can see here in this chart, we've got enrollment growth. What's interesting here is the trades are really strong right now as we talk about vocational schools. You can see that line, that kind of like peach line, is just like going through the roof right now, whereas we've got community colleges and four-year institutions that are, basically kind of treading water, if not slightly up. And I think all of these looks like these numbers were all indexed back to 2019. And so, clearly there's a breakout in vocational aspirations as far as student enrollment goes. So we got ISM PMI here, and then that's overlaid with annualized GDP growth. In other words, economic growth. You can see that in the red. Obviously, we've had greater GDP growth than what we assumed was going to be the case, at the same time that we've got ISM services, and we already looked at the ISM numbers for manufacturing, and those went back above 50. Now we've got services numbers that have been in some decline, but they're still in expansion mode. And so what does this suggest to us? That maybe we get slower growth. And that's the caption here on this Oxford Economics little chart piece here. And that wouldn't surprise me very much. I think, what has been surprising is the magnitude to which we have exceeded expectations on economic growth over the last couple of quarters, and this quarter likely to be no exception. Much stronger than we thought heading into the beginning of the year. So again, I think we're not. I guess we're not anxious about this, but we're kind of girding ourselves a little bit for the fact that some of these indicators, while they're really strong right now, tend to suggest some slowing in the economy. And clearly, when you talk about a law of large numbers and year-over-year change, that when you have a couple of years of relatively decent growth, that it's hard to annualize that. And, inherently, you hit that law of large numbers, and those deltas the changes have to be significant to really drive that percentage. And so this chart does have some kind of predictive power to some degree. And, if we get a little bit slower growth, that's absolutely not the worst thing in the world. Another indication of kind of where we are in the economy. We've shown you a lot of data on the consumer. We've showed you some data related to excess savings here over the last couple of months, and that is clearly going down. But here we have more credit card usage on the part of individuals, and you can see that the delinquency rates are picking up. Are they at levels yet that we would that we would consider to be kind of catastrophic? No, absolutely not. But they are moving higher, and so when you think about a relatively strong labor market with 3.8% unemployment and initial jobless claims that are lower, you clearly have some of these other things at bay. You've got services economy that's kind of slowing down, even as manufacturing is coming out of its own kind of recession. And frankly, if the consumer wasn't as strong as they were and services didn't pick up when they did post-pandemic, I think we would have absolutely been in a recession, because manufacturing certainly was. But looking at this chart, it just tells you that we've got consumer issues on the margin that, that while they're not overly concerning right now, we absolutely need to pay attention to it. Here we have a commodity index. We've been watching commodities over basically the better part of a year and a half now that have been just really sluggish. And, we saw a real spike in commodity prices back in the post-pandemic environment, and those have clearly eased. Now, frankly, they're coming off of highs, and we see here the commodity index from Bloomberg showing you that peak at the beginning of 2022. And then we had basically the rapid rise in interest rates, and that took a lot of steam out of the commodity basket here. But they have picked up most recently, and you look at that blue line there, that's a 200-day moving average. And so technically speaking, it's important when you have a breakthrough like we just have had, where the current commodity index is breaking through that moving average. And you can see about the third quarter of last year, we had a similar, about 2-3 times it happened, and it was kind of a false positive because the index kept going down. But it will be interesting to see if we have seen a bottoming in commodity prices and if those are apt to move higher. Here we've got the volatility index. Looking at this on the equity side, we've had a bit of pickup in the volatility of the stock market as of late. You can see here in this chart that it's been fairly benign, fairly low. We've had bouts of fairly strong volatility, but when you look at it from like basically the end of last year up until March, it's been pretty benign, and just recently have we seen that spike and fall. We talk about equity fund flows. They've been exceptionally strong. We look at this, here's the aggregate weekly fund flows, and you can see that they've been positive. We had a really strong week back at the beginning of March, and by and large have had strong weeks altogether. And so this is a 12-week moving average, and you can see that fund flows, as you smooth it out, have actually been extremely positive here. So a lot of enthusiasm in the market, a lot of, I'd say, very limited anxiety. So when you look at the backdrop and you say, all right, well, we got ISM services that are slowing, labor market may be still strong, but we've got consumers that are, a little bit more delinquent on their credit cards. That's not being evidenced in the equity market. So we've got a lot of positive fund flows there. Now we look at a little bit of valuation, and so a couple of things here of note. I mean, basically we've got international is just extraordinarily attractive right now, and this is basically a relative valuation. So the weaker that this goes, that basically shows you the discount of the valuation of international stocks relative to U.S. stocks, and that differential from a price to earnings basis is extraordinary. It's 35% below, which I don't want to get too mathematical here, but it's 2 standard deviations below the average discount that international stocks have relative to the price to earnings ratio of U.S. stocks. And statistically, this means that this only happens 1 in every 100 years. So it's a very rare occurrence, and you can see the current PE ratio. S&P 500 capitalization weighted index is about 21 times, and then basically international stocks are about 14, which is close to their long-term average. But U.S. equities are basically much more highly valued than they have been. Now, if we look at dividend yields, it is a very interesting story as well. So we've got the S&P 500. The current dividend yield is about 1.4. Historical average is about 2. So obviously that's a function of stock prices being higher. Now, if we look at international, the average yield is about 3.1, which is just below the long-term average there. And you can see that differential is very uncanny. So, I mean, there's a yield advantage here that not quite. At one point it was over 2 standard deviations, but just call it like close to 2. Again, this is like a 1 in 90 chance. This is ridiculously out of whack right now, and I think it presents an opportunity for patient investors on the international front. So this chart is interesting in that it kind of foreshadows more stock repurchase activity, which is very good. And we'll see here in a second how influential that has been as of late. And so, in other words, basically expect repurchases to continue. If you look at this chart, you've got the CEO business confidence index here, basically expectations for the economy looking out 6 months ahead. And so, that's in the blue line. That troughed in 2023. We were monitoring this pretty closely because oftentimes this is a precursor to what CEOs actually do, i.e. they pull in capital spending, they become a lot more circumspect on hiring, and in some cases maybe that's happening now a little bit defensively, but clearly CEOs are more optimistic than they were. And you look at this relationship that goes back to 1998, there's a reasonable positive correlation here. And so, this idea, this little fish hook up here says, still would suggest that you're going to have more stock repurchase activity as CEO confidence improves. Now we'll turn our attention to the Treasury market for a second. Here we've got the 10-year Treasury note yield. We've had a little bit of volatility here. We had a lot of volatility last year and clearly in 2022, and almost more volatility in the fixed income markets that we've seen in the equity markets. And certainly that has been the case net since the beginning of the year. We look at the end of 2023, rates were down about 3.8%. They moved to, at one point they were 4.4 and they closed at 4.35 here, towards the end of the week. And, we've clearly seen them as high as 5% when we go back to 2023. So, here looking at less than a year's worth of time, we've had a tremendous amount of volatility in the fixed income markets. And, you assume that we're about 4.4 here on the 10-year, you're about 4.6 on the 30 and about 4.8 on the 2-year. So we're still inverted, getting a little bit better action in the Treasury market kind of consistently as some of the positive economic developments have been reinforced. Whether or not you believe that those are short-lived, there's clearly a lot of increased momentum for yields at this point. So now we'll look at sentiment in the investment markets overall. You can see the dark blue represents bullish. Kind of that gray line or that part of that bar represents neutral feeling. So you can see really over the last several months, we've had a pretty stark increase in the bullish signals, and that seems to be manifested in fund flows that we saw earlier in the chart pack. And so this is just kind of reaffirming that. Clearly a lot more optimism in the market, not a lot of anxiety. It doesn't really matter what kind of charts I show you right now. There's a lot of fund flows and a lot of people, I think, trying to catch some of the returns that they might have missed last year. Still looking at sentiment here. This is the American Association of Individual Investors sentiment bearish ratings. And so this represents kind of the percent of the population that is not optimistic. And you can see here that that number is actually very low. When we've had these troughs before, we go back to basically the beginning of 2018, you had 19, and you get these dips, and this is a pretty noisy data series here, and so it does have a lot of ebb and flow, but this does corroborate to a large degree what we're seeing elsewhere in the market in terms of investor enthusiasm. So we are on the eve of earnings reporting season, and so we're heading in the first quarter. If you look here, long-term average is that earnings beat the estimate by about 5%, and right now the expectation is pretty much in line with that. Again, that could change. As we looked at what happened a little bit earlier in last year, we did have some erosion of confidence, and I think that was getting people a little bit unnerved, a little bit about where we were in the economic cycle, but then that turned around and we closed the year on a very high note in terms of earnings. And so even if we slip a little bit and the beat's only about 5%, that would be pretty much in line with long-term averages. Now we look at this chart for equity demand. And so what does this really mean? So this is, looking at the purchasers of equities. Who are they? What groups are they coming from? And you can see, pensions have been net sellers over that time frame. This is since 2000. And so pensions have moved much more proactively into private equity. And so this is not U.S. publicly traded equities. This is like more a shift towards private equity and private investments. And, in some cases, some of these pensions have 40% of their assets tied up in these so-called illiquid kind of long-term investments. And then mutual funds, this is almost a push. This is basically about $500 billion, but with all the assets in the mutual fund industry, that's a little bit of a push. Households a little bit more. We know that greater percent of the population owns equities now. And then we look at foreign investors, people looking into the U.S. market with perhaps at one point a more stable dollar. This is actually a big move, but what is really compelling is the corporate number here. And this represents buybacks. So this, as we talked about earlier, we feel like stock repurchases are apt to go up, and that's a return of capital to shareholders. And so when you have this kind of environment, it does help to support your calculation of earnings per share, right? In some cases, these companies are buying for treasury stock, or in other cases, they're buying to actually retire the shares, or they're buying back stock to help satisfy, option grant exercises and whatnot. But when you think about $5.5 trillion, that's a pretty powerful number. When you think about the health of the market, you think about where some of the impetus is coming from. Clearly, corporations and stock repurchase activity has had an impact. Now we look at the time series going back to 1990. This is from J.P. Morgan's chart pack, we've talked a lot about the difference between the market-weighted index, which is basically, for lack of a better definition, like the average stock in the S&P 500. So you got on average 500 stocks, and each one of them has an equal weight regardless of how big they are. And that is differentiated between the market cap weighted index, which we know is heavily dominated by technology and heavily dominated by the top 10 stocks, and the rest of the 490 have basically far, far less influence. And so the difference here is that we've had, as much as we talk about it, we go back to 1990, that essentially 53% of the time we've had the equal weight index that's outperformed. And you can see those periods are in the gray here. And where the market cap weighted index, again, think about like the Mag 7 or whatever, they've led about 47% of the time. So it's almost half and half. You can see the current PE ratio here is 21 times. We actually talked about that earlier in the chart back. Now the equal weighted index, again, basically taking out the influence of the highly priced ones, it's about 17 times, pretty much in line. Average PE since 2009, about 15 and a half, call it 16. So this is not out of whack. This, however, is, but we've seen greater breadth in the market. So even though we've seen a year-to-date positive number for market cap index, we've seen some relative performance coming out of the equal weight as well. Something we don't talk about a lot, but I find it pretty interesting looking at this chart, is we got preferreds, and these are fixed rate preferreds, and they typically trade at a $25 par value, and but they can be quite volatile. And so these, when you get into a situation where credit spreads are blowing out and everyone's worried about the economy and you see rising default rates and things like that, these preferreds get hit pretty hard. But right now, what's interesting is credit spreads are extraordinarily tight. There is, on balance, net optimism on the economy, but yet you have these preferreds trading at a discount that we haven't seen since the global financial crisis, and that's really, really odd. And to the degree that you believe these credit spreads are going to hold, to the degree that you believe that we're not going to go into a recession, and that maybe we engineer the soft landing, and maybe we've already seen the softest part of the soft landing. Who knows? But even if you expect, as we do, that maybe you're going to have slower economic growth looking out into the rest of this year, these investments seem to be pretty compelling right now, and they offer really good yields. Well, that'll do it for the chart pack this week. I hope you've enjoyed that, and look forward to getting with you again next week. In the meantime, be safe as you're staring at the sun tomorrow, and happy eclipse, and we'll talk to you again soon. Take care.